So, what if our entire financial system was built on a totally different foundation? Not on transferring risk, but on sharing it. Today, we're jumping into Islamic finance, a system that has a fundamentally different set of rules, all designed to connect the world of money directly to the real world of things, of services, and, partnerships. All right, let's get into it.
Here's how we're going to break it down. First, we'll look at the problems in conventional finance that this system is trying to solve. Then, we'll get into the core idea, risk sharing. From there, we'll see how you can actually run banks and markets without interest. And we'll wrap up by asking the big question. Could this actually be a more stable way to do things?
Okay, so to really appreciate the alternative, we first have to get a handle on the problem. The sources we're digging into today argue that the conventional interest-based system, well, it has some design flaws baked right in that can make it pretty unstable.
Now, this phrase right here is so important. An inverted credit pyramid. It's such a powerful image, right? Just picture it. It describes a situation where the financial world, all the debt, the derivatives, the super complex products, grows way, way bigger than the real economy it's supposed to be supporting. We're talking factories, products, actual services.
To put it really simply, it means you've got this enormous structure of financial promises and debt balanced precariously on a tiny little base of actual tangible stuff. And you can probably guess what happens when that tiny base starts to wobble. The whole pyramid can get dangerously unstable fast.
So what this all leads to are a few major issues. The world of money just kind of floats away from the real world. You've got banks borrowing money on a short-term basis, but lending it out for the long term, which is a classic mismatch. And debt starts growing way faster than the actual economy, which just builds in this massive potential for shocks and crises that can spread like wildfire.
So, if that's the problem, what's the solution? Islamic finance comes back with a system built on one single, really elegant principle: risk sharing.
And this slide right here, this is the absolute core of it all. It's the fundamental difference. In the system we're used to, a lender transfers risk. They give you a loan, and you owe them that principal plus interest, period. Doesn't matter if your business succeeds or fails. All the risk is on your shoulders. In Islamic finance, a financier shares risk. They essentially become your partner. If things go well, you both share the profits. If they don't, you both share the loss.
So formally, it's all about collective responsibility. The outcome, good or bad, is carried by everyone who signed on. It's really the difference between being a creditor, standing on the outside, looking in, and being a partner, right there in the trenches with you.
Okay, that sounds great in theory, but how do you actually build a whole banking system around that? I mean, a bank that doesn't charge interest? How does that even work? Let's look at the special contracts that make it all possible.
All right, the first key tool is called mudabara. Think of it this way. One person brings the money, the capital, and another person brings the know-how, the expertise to run a business. They agree up front on how they'll split any profits. But, and this is critical, if the business loses money, the investor who put up the capital bears that financial loss. The manager just loses their time and effort.
The second one is musharaka, and this is what you'd probably call a true partnership. Here, a bunch of people pool their money or their skills, or both. They become co-owners of the business, and they all share in the profits and the losses, basically according to whatever stake they have in the project.
So how do you make a bank out of these ideas? The sources point to two main models. You've got the two-tier model, where all deposits are basically treated as investments. But this two windows model is really fascinating. It splits everything up. Your regular checking account is treated just for safekeeping, with 100% cash reserve behind it. Then there's a totally separate window for investment accounts, where your money is used to share in risk and reward.
And here's what that actually looks like on a bank's balance sheet. Just look at the asset side. It's all tied to real things: financing trade, leasing equipment, real investments. See how this directly prevents that inverted pyramid we were talking about? And on the other side, the depositors and investment accounts, they're not lenders. They're basically partners, sharing in the results of those real-world assets.
Now, this whole idea of risk sharing, it doesn't just stop with the banks. It actually extends out to the entire financial system. We're talking capital markets and even insurance.
So what does a capital market look like if you take out interest-based debt? Well, the whole focus shifts dramatically. Instead of these massive bond markets, the stock market becomes the main event. And it makes sense, right? A stock market is pretty much the most sophisticated, natural way for people to share risk and reward in an economy.
To replace bonds, you get something called sukuk. Here's the basic idea.
You take a bunch of real, tangible assets that generate income. Think buildings with leases. You put them into a separate legal entity, an SPV, and then that entity issues certificates that represent actual ownership in those assets. So instead of getting a fixed interest payment, investors get a piece of the actual income that the assets generate.
And what about insurance? The alternative here is called takaful, and it literally means mutual guarantee. It's a total shift in thinking. Instead of transferring your risk to a giant company in exchange for a premium, it's a co-op model. All the participants pool their money together to insure each other.
Just look at the comparison. With conventional insurance, you transfer your risk, and any extra profit goes to the company's shareholders. With takaful, the risk is shared among the group, the participants actually own the fund, and if there's any surplus at the end of the year, it's shared among them. The policyholders are both the insured and the insurers.
Okay, we've seen how all the individual pieces work. So let's zoom back out and connect this all back to that problem we started with. The big question is, does a system built on sharing risk actually create more stability?
Well, the argument is a strong yes, for a few key reasons. First, because a bank's profits and losses are passed through to its investment depositors, you get rid of that dangerous asset-liability mismatch. Second, banning interest automatically cuts down on excessive debt and leverage. And most importantly, all financing has to be tied to the real economy, which keeps that inverted pyramid from ever forming in the first place.
Which brings us right back here to this final thought. In a world that has been rocked by financial crises born from too much debt and too much risk shifting, is it possible that a model built on partnership and shared outcomes could give us a more stable, more resilient foundation for the global economy? It's definitely a powerful question to chew on.